Happy New Year to all of you out there from our team at SD Bullion. For gold in fiat US dollar terms, this was another consecutive weekly close above 2,000 an ounce, and for the first time in history alongside monthly, quarterly, semi-annual, and annual closes above 2,050 an ounce. Later in this report, we'll take a look around the world at where major gold and silver markets are finishing this year, 2023, with a roadmap ahead for how much further both respective precious metals have and potential revaluations higher to come. First, a quick follow-up on last week's SD Bullion Market update regarding the Biden administration's demand that the EU come up with a plan by the end of February 2024 to potentially confiscate Russia's $300 billion in frozen U.S. Treasury savings and hand it over to their opposition in war, Ukraine. The Financial Times covered that story this week, while former U.S. debt plumbing system architect Kathleen Tyson stated, quote, "This expropriation of Russian assets will punctuate the end of a century of FX official reserves accumulation, except in G7 daisy chain and Anglosphere states. The rest of the world reverts to gold in self-custody as reserves and innovates new bilateral trade models for food and energy security." Even Nobel-winning economist Robert Shiller admitted this week to a paper in Italy that such an action would cause a cataclysm on the US dollar system. Meanwhile, the Wall Street Journal reported this week that already an estimated 20% of the global oil trade was bought and sold in fiat currencies outside of the once dominant fiat US petrodollar. If the stock market is designed to gather the largest amount of retail buyers before its typical lost decades, perhaps we are again nearing another such point, as US households' exposure to stocks is as excessive as it once was before the lost decade and a half, starting the year 2000 all the way to 2015. And well above the overexposure stocks achieved before the lost decade of the 1970s. In regards to current prices of gold versus the S&P 500 stock index, other market onlookers echo a point I keep hammering home on this channel, suggesting it's time to possibly rotate some stock winnings into bullion before the next major shift in revaluation trends commence. Commenting on the room for gold to move in the coming years, David Sommers states, "It would certainly seem that there is room to go a lot higher. The price of an ounce of gold in dollars divided by S&P level is still only 0.435. It was 1.69 as recently as August 2011. With the S&P at 4,781, a comparable ratio would make the price of gold 8,079 per ounce." What David is referring to is merely for gold divided by the S&P 500 getting back to its August 2011 levels. This chart here helps illustrate how crazy the overvaluation of gold over the S&P 500 can get during bullion bull market mania phases, like the high we witnessed back in the top of January 1980. There's a massive runway for gold to outperform stocks in the years and perhaps decade ahead. Yet the Western investment advisor class is still asleep on gold, with near no allocation at all. Of what allocations they would make will likely end up not in bullion outright, but in inferior unsecured underperforming mining shares and or unsecured ETF slush funds like GLD or IIU. Gold market investor and commentator Fred Hickey wonders aloud what happens with gold prices once Western institutional investor classes return to reallocating back into gold, stating the following this week on Twitter or X. "Ever so quietly, a new record high close today for gold. Little enthusiasm or fanfare and virtually no interest yet from Western institutional investors. GLD ETF stuck at 878 tons, flat against the same level born a third years ago. When gold was just 1,500 an ounce. In May 2019, GLD ETF held just 733 tons and gold was 1,290 an ounce, but Western investors started getting involved, adding 535 tons to their GLD holdings over 15 months. Helped catapult gold plus 750 an ounce, plus 60% over that period. That's the potential impact from return of West institutional buyers. Since March 2020, back when COMEX began double counting unsecured 400-ounce gold bars and ETFs, additionally, as supposedly backing their fractional reserve warehouses, we've seen a steady drop in the reported GLD tonnage divided by gold price ratio. That ratio is now down to its lowest level since the world's largest unsecured gold slush fund began its existence all the way back to the year 2005. Sure, the accounting trickery bought the COMEX more time and the illusion of stability, but their underlying fractional gold pile has been basically cut in half over the last just over 3 years of time. In financial history, 2023 may be remembered for the starting block of a future global banking crisis. This chart is only updated through May 2023, but in total there were 5 failed US banks this year. And Swiss G-SIB, Credit Suisse, basically failed by being bought out for pennies on its once bloated share price by UBS. There have already been over 61,000 bank jobs lost in the year, and we suggest this is only the start, as the system consolidates toward a global bank system trend which will have more CBDC adoptions and market share in the years upcoming. And while hard US debt is on the cusp of ballooning past $34 trillion to close the year, in which another diluted stock market bubble nears its all-time nominal highs, I again suggest considering that gold bullion will likely be looked upon, like in past stock market bubble eras, as being cheap. Even now priced at just over $2,000 an ounce, that will be deemed cheap in the decades ahead. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates. Subscribe to our channel here for weekly bullion market updates with exclusive bullion service offerings like this one.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at sdbullion.com/IRA.
The spot gold price closed above $2,050 an ounce, again completing record high wicks on monthly, quarterly, and annual charts, which is important for chart onlookers in search of bullish technical breakout signals. The spot silver price finished slightly down on the week, just under $24 an ounce for the end of the year 2023. The spot gold silver ratio rose on gold strength over silver to finish at 86 on the year. Industry spokesgroup for the silver investment industry, the Silver Institute, was out again this week highlighting ongoing and further upcoming deficits, situations where current shrinking silver supplies versus increasing demand in the global silver market, which has become the norm, is going to continue to be the norm in the decade unfolding. They also briefly highlighted the promising future for silver in replacement of platinum group metals in potential industrial applications for the growing hydrogen fuel economy to come. As well, they covered that mining strikes in the largest silver-producing country of Mexico put a damper on silver supplies coming out of our neighbor to the south this year. Yet they didn't mention the key and most important point, that major silver exchanges and depository inventories of silver bullion in China, on the COMEX, and in the City of London have seen major reductions since the spike-high levels during the 2020-2021 COVID peaks, dropping negative 73%, negative 70%, and negative 32% respectively over the last few years. At some point, all these contributing fundamental and fiat financial folly factors will result in a rapidly climbing silver spot price, and I suggest we're not all that far off from that time, as yearly price charts in major gold markets are signaling now that they will begin becoming unaffordable to the average woman and man on the street. Annual gold price charts in fiat US dollars, fiat euros, fiat Chinese yuan renminbi, and fiat Indian rupee are all signaling breakouts that are either underway or are about to begin in earnest. The same cannot be said for laggard silver, and that is what bullion bulls should expect to see. Gold leads, eventually silver follows, and outperforms even gold in an eventual bullion bull market mania. Here's annual silver price charts in fiat US dollars, fiat euros, fiat Chinese yuan renminbi, and fiat Indian rupees, with the final fiat rupee chart for silver closest to a coming breakout phase where the poor man's gold, silver, does its typical outperformance run over gold. Thus far in the 21st century, gold has outperformed silver. But before this bullion bull mania ends, my suggestion is we'll likely end up seeing something akin to what we saw play out in the late 1970s and into early 1980. If that does occur, we could see a day where from here to there, silver outperforms gold by more than 4 times. If you believe, like I do, that we are slowly stumbling into one of the biggest store of value crises the world has collectively ever endured, owning bullion, especially one which is still more than half off its all-time nominal price high from 53 years ago, well, that will likely prove to have been a sound decision in the long term. That's going to be all for this last 2023 edition of our weekly SD Bullion Market Update. We'll see you in 2024. As always, to you out there, take good care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.